Hello, fellow Rebel Capitalists. Hope you're well. So I am here with my good friends Lynn Alden and Chris MacIntosh. They are the best in the business. Chris MacIntosh, hedge fund manager. Lynn Alden, macro analyst extraordinaire. And in the comments of my videos, I always get, well, George, I understand what you're saying about the global monetary system, about the conflict, the geopolitics involved, potentially World War III. We got inverted yield curve. We got all these things that we need to be cognizant of. But what do we do? I mean, do we buy gold? Do we buy silver? Excuse me. Do we buy commodities? Do we buy the TLT and wait for a recession? Do we be in cash? So anyway, Lynn and Chris are the best pros that I'm aware of. They're the best in the business. So I wanted to get them on today to talk about what they're doing in their own portfolios and how they're positioning themselves and their clients, in the case of Chris, to not just weather the storm, but to build wealth and thrive in this world that's totally uncertain, this chaotic world that we live in right now. So guys, thanks for coming on to the Rebel Capitalist channel. This is going to be a really awesome hour webinar, and I can't wait to dive in. So I guess on that note, why don't we start with Chris, and we'll go over to Lynn and just talk about kind of your macro view right now. What have you been thinking about the most over the last week or so, and then how are you positioning yourself accordingly?
There's so much to go over, George, and I think if we just dial back a little bit prior to the Israeli conflict that's now launched onto our screens, what we've had is the setup where, at least within the Western world, things have changed substantially for the main participants in the Western world, and I'm not sure everybody fully understands the relevance of it. And basically what that comes down to is that the US is largely self-sufficient in energy. Europe is not. And not only is Europe not self-sufficient in energy, they have now an inability to acquire their energy from the sources that they previously were supplied by, which puts them in an incredibly precarious situation. It is one whereby they are deindustrializing at the same time that we have a global energy crisis. So it's, you have a domestic, if you want to call it that, at least within Europe, issue, as well as an international macro issue with respect to the energy landscape, which is just a pure supply-demand cyclicality issue. And so now we're seeing central banks acting because central banks don't have the ability to increase supply of anything, right? What they can do is they can reduce demand. And so we've seen quite a bit of that with respect to rate increases. The issue, of course, with rate increases is that, and this is the prickly situation, whether it be the ECB, the BOE, or the Fed, ideally they don't want to have a recession, because a recession brings hardship and frankly, if it's too dramatic, social instability.
Right.
So what they want to do is they want to reduce demand, but at a lower price, and that's a difficult thing to do. And so that's the sort of backdrop, if you will, to the environment that we found ourselves in when the Israeli conflict broke onto our screens last weekend. It is a classic stagflationary sort of environment, while at the same time being one with a global fragmentation, which is there are so many trigger points that if you just, I've got a map in my office here, like a massive map on the wall, and I literally look across the globe at these various geopolitical choke points, these various structural sort of countries and alliances, and like I could literally just list like a dozen that are today more precarious than they were yesterday.
So we got a geopolitical powder keg is the bottom line.
Exactly. And so basically, I think what we're looking at and have been preparing for, quite frankly, now it's just really a matter of tweaking things around the edges on a constant basis, is that we have a stagflationary environment, which is essentially a war scenario. I think most people need to consider a a war environment and what that would mean for sectors and portfolio assets. And the other thing I think that is likely, and it's already begun, but I think it's probably just baked in the cake for the next, I don't know, 3, 4, 5 years, maybe more, is volatility, the likes of which we've not become accustomed to, or not
Right.
and not familiar with.
Right. All right, Lynn, what do you think? What has been on your radar over the last week, and how have you changed your portfolio, or have you, due to the events of what's going on in the Middle East right now?
Yes, I think, the overall long-term views are generally unchanged. These things, while individually unpredictable, tend to happen more frequently when we're in the environment that we're already in. So one way to think about it is that, sovereign debt crisis leads to war and inflation. War and inflation lead to sovereign debt crisis. It's kind of this feedback loop until you get to the next epoch. Um, Another way of putting it is that inflation leads to disorganization. Disorganization leads to inflation. Um, and so there's two kind of major themes I track at the current time that are tied directly together. So one is that for the past 40 years, the United States has had, and most of the developed world, has had rising debt as a percentage of GDP, public, but falling interest rates. And so if you double your debt levels, but you cut your interest rates in half, your interest expense is still manageable. It hasn't changed. And so, especially in this kind of the past 30 years or so, they've had that sharply falling interest rates. And the problem now is that when you bounce off zero and you start going sideways to up, that interest expense actually starts to matter. And so we're kind of in this phase where for 30 years you could kind of ignore the public debt. And now it's getting to a point where you can't really ignore it. And it's one of the sources of inflation, along with other things. That's kind of one of the demand movers of inflation, or just like a debasement mover of inflation. And so that's number one. Number two is the geopolitical aspect, and it ties into that because if you look at a long-term chart of public interest expense, it was sharply rising throughout the 70s, 80s. And that was kind of the peak time when people got concerned about the debt. So the national debt clock went up in the late 1980s. And some of the early elections in the 1990s, you had major candidates like Ross Perot that were really kind of putting focus on the debt. It kind of hit a crescendo there, and they kind of got they marked almost a top because with the opening of China and with the fall of the Soviet Union, it kind of opened this big period of disinflation. So you
Right.
basically brought Western capital together with Eastern labor, and so you build up all these Eastern, Asian manufacturing facilities. You connected cheap Russian gas to Europe, and these were big. These were boosts of productivity, boosts of abundance, and disinflationary. And so a lot of those debt problems fell away, and people said, debt doesn't matter. Those people were calling wolf, and for about 30 years that was correct. And the problem now is that mathematically, when you run into zero rate and then bounce off of zero, and when you've kind of exhausted those 30 years of like a peace dividend, and now we entering a more fragmented world. So the U.S. and China, more rivals now. Obviously, what's happening, with Russia's invasion of Ukraine and now Israel, some of these ties that have been, more solidified over the past 30 plus years are less so. And so the combination of having public interest expense actually become a problem, mixed with more challenges on the supply side, which can feed on themselves. I think that's setting up a more, on average, inflationary decade, and on average, a less energy secure decade. So higher average energy prices, risks of energy volatility. Um, and so I think that's what we're kind of optimizing for, at least from my perspective. To the extent that things changed in the past week, um, I think that I've been a bond bear since 2019, and the nominal drawdown on bonds was surprising even for me, even as a bond bear. I think that tips are starting to get a little bit more interesting from the long side. If you wanted to say rotate a little bit of capital out of, say, the Magnificent Seven equities that have just kind of gone only up, and I think that some of those I'm not exactly a buyer of bonds in general, but I do find that the tips real yield to start being somewhat interesting.
Mm,
And also, if we do start to see kind of a stabilization in real yields, that's also what helps give gold and other types of assets some real legs.
right.
Um, for the next 6+ months, a key thing I'm watching is so right now we have this very kind of loose fiscal environment, but obviously you have the tighter Fed environment. They're doing their best, as Chris mentioned, to slow down demand to try to modulate what's happening. And so one thing we have to look at is how long can they maintain this? Because combination of a strong dollar, rising yields, and high energy prices does put a lot of downward pressure on the world economy. It does put downward pressure on the domestic economy. And the question is who's going to buy all of that massive treasury issuance? So if the Fed's not buying, banks are not buying, the foreign sector is not buying. Really, the only place to absorb it is domestic non-banks, and they have limited overall balance sheet capacity. And so right now, the Federal Reserve is drawing down their balance sheet, but they're also the reverse repo facilities drawing down. And as that draws down, that actually pushes liquidity back into the financial system. And so that's been happening at a roughly equal pace. And so ever since the banking crisis earlier this year, overall domestic liquidity has been roughly flat. And the reverse repo probably has about 8 months more or so before it would be drawn down at the current pace. And I think after that, we start to get interesting questions like can the Fed still be as tight as they are in the face of so much fiscal issuance? And I think that's where we might get more of a regime change outside of this kind of current environment. But right now, as long as the Fed's drawing down their balance sheet, I think a more risk off type of outlook makes sense
How
to
do
be
how
kind
do
of
you reconcile the risk off with the supply or lack of demand right now at the long end of the curve? Because if you're risk off, then you would assume that that demand is going to come back real quick with treasuries, almost regardless of supply, depending on how hard the landing is. And to your point, we've got a lot of things that would lead to the global economy really slowing down, especially the high dollar. And then if that impacts the US economy, then how obviously we're discussing, so many people make the mistake of just being in one camp or the other. You're either a bond bear, bond bull, or dollar bear, dollar bull, inflation, deflation, whatever. And I think that most people, it would serve them well to understand that we're talking about cross currents. And at any given time, we've got massive inflationary pressures and we have massive deflationary pressures. So in that world, and then looking at the inverted yield curve, I mean, that's the elephant in the room, right? So looking at the curve and looking at all these downward pressures on inflation, and which would be bullish for the long end of the curve or bullish for treasury prices, how do you reconcile that with the, to your point, massive supply of treasuries, and then who's going to be your buyer?
So I mean, the size of the fiscal deficits as a percentage of GDP outside of recession or direct war are rather unprecedented. That's
Right.
what kind of feeds into this, what I would call kind of the early signs of basically a sovereign debt crisis. And so again, a lot of the biggest buyers are essentially leveraged, like banks, the Fed, right? They can buy very large amounts when they're buying
Mm,
because they're not buying with finite balance sheet capacity.
right.
The problem is that the remaining buyers, even if they do have a somewhat risk-off stance, um, they're buying with finite capacity. In addition, a lot of people are momentum traders, so when they see just bonds constantly going down, uh, they tend to get on one side of the boat. And so that's why I'm starting to mention that after this drawdown, I do think we could see a little bit of rotation here back into bonds. And
Right.
my preferred risk way to play that is the tips, because if I'm concerned about energy prices,
Hmm.
um, I'm less inclined to go with the nominal bonds, even though I think you could certainly have a tradable bottom with them. But when we look at the huge amount of supply coming to market with some of the stagflationary concerns I have,
Yeah.
I still don't love the nominal trade for the bonds, but I do think that the tips are getting interesting, and I do think that if this much issuance keeps coming to market, the Fed keeps holding their situation tight, at least for the maybe next 8 months, the risk reward for the say S&P is just not particularly attractive, and that's different than necessarily saying a hard landing. I mean,
Mm,
if the S&P 500 goes sideways for a year and T-bills pay you 5%, your hurdle rate is no longer 0, it's over 5%.
right.
And so, and then also you volatility adjust that. So even if the S&P 500 were to return 6%, if you had to have a lot of volatility to get that 6% compared to, 5%, no brainer investment, the risk reward, I think, favors things like, T-bills or tips at
Mm.
the current time, at least, in terms of portfolio weightings, percentages.
Yeah, Lynn, one thing that we talk about in Rebel Capitalist Pro all the time is commodities. All three of us are very, very bullish on commodities long term. And I've had a little bit different view than I think you and Chris, and that you guys have been building that position for the long term, for the next decade. Where with my personal portfolio in Rebel Capitalist Pro, I've held back a little bit, stayed in the T bills, and wait for a little bit of a pullback. Now, will we get that pullback or not? I mean, who knows, right? Especially with what's going on geopolitically. But that's just been two slightly different strategies. Now, one thing I know Chris was talking about in Rebel Capital's Pro with our members is potentially building a position in commodities for the long term, but hedging that out a little bit with the TLT. What do you think about that?
I think that's a reasonable approach. I've generally been playing on a commodity basis. So, for example, I've been bullish energy producers. I've been bullish direct uranium. Um, Whereas, for example, I have, for a while been cautious around copper because that's a little bit more
Yeah.
cyclical. That's a capex metal rather than like an opex commodity.
Okay.
Um, One way to kind of, I think, answer your question is to think that, the average portfolio, the classic 60/40 or even a risk parity, these are very disinflation oriented portfolios. They like falling interest rates, rising valuations. Both the major like the major stocks and the bond side both prefer generally disinflation. The problem is that when you enter a more stagflationary environment, those correlations tend to be, together, meaning that,
Mm.
stocks and long bonds can do bad together, which is why I think adding a significant commodity position to a portfolio, whether it's commodity producers, whether it's gold, whether it's Bitcoin, probably a combination of a lot of the above, that is now a inflationary hedge in a portfolio that is otherwise very disinflationary focused.
Mm.
Um, and so, to the extent that someone still has TLT in their portfolio, they obviously did very bad recently. It, the oversold, it might start getting interesting from this level, at least as a trade or as a hedge. Um, again, I like the risk reward of tips and T-bills somewhat better.
Okay.
But I do think that as long as someone has some inflationary protection elements in their portfolio compared to the average large asset portfolio that is very disinflationary focused, then I
Mm.
think they're relatively fine.
Yeah. I've got a question for both of you, and it's something I've been giving a lot of thought to. And I'll go ahead and ask the question. We'll start with Chris, and then we'll move back over to Lynn. In this world where we've got these stagflationary pressures that you guys talk about all the time, we talk about oil going to $150 a barrel as an example. And everyone on this live stream right now realizes that if oil goes to 150 or 200, whatever, that's going to impact prices. It's a input cost for the majority of the stuff that we buy, obviously with transportation. So that would put massive upward pressure on prices. But where I struggle and what I've been wrestling with is looking at it through the lens of a monetarist, right? Because you've got all this upward pressure on prices, but if incomes aren't going up, at a certain extent, you're robbing Peter to pay Paul. And if you look at M2, and I know M2, I hate to really use that because it doesn't reflect the aggregate balance sheet, because I think a lot of times you're trading savings for treasuries and that money's going to heaven because of the Fed's doing QT. But just let's assume for a moment that M2 is a proxy for the overall currency units that are chasing goods and services. Uh, and then I did a video yesterday on how nominal incomes in 17 states right now, household incomes are going down in nominal terms, for heaven's sakes. And you've got a few states where nominal incomes, household incomes are going up, such as Florida, but they're only up by like 1.9%. They're not keeping up with the rate of inflation. So I think to myself, okay, could we have a scenario where prices are going up, but the average Joe and Jane can just buy a lot less? And they can buy so much less stuff that trickles down into the businesses themselves. They're selling less stuff, their margins decrease, that increases the unemployment rate. And then all of a sudden you've got nominal wages going down even further. And you have this kind of feedback loop. So in my mind, I see higher oil prices or a stagflationary environment short term, but I see that almost leading to, ironically enough, a disinflationary or deflationary environment unless something changes with M2, such as the government coming in and doing deficit spending that's monetized by the Fed, or something like that. How do you guys see that stagflationary view through the lens of, let's say, Milton Friedman?
Do you want to start with me or Chris?
I was going to start with Chris, but Lynn, if you're ready, it looks like Chris is giving it some thought.
One thing I would say that I think that the overall M2 growth picture is going to change in the 8 to 12 month period.
Okay.
So the fact that it's not growing significantly right now is part of why I have a defensive view, or at least a more defensive view. But I think that after we get to the point where the reverse repo facility is drained, the Fed runs risk of having treasury liquidity problems if they're still shrinking their balance sheet at that point. Um, and so I do think that, when we look out at, say, second half of 2024, maybe 2025, if they push it out longer, I expect another reacceleration of
Okay.
M2. But, in that intermediate term is where again, I like the T-bills, I like the tips, gold, maybe some more defensive equities. Just not a lot of overall risk taking, degrossing, not having kind of like strong levered views on things. And part of why commodities are very useful in those types of stagflation environments, because as you pointed out, when the cost of living goes up a lot, people get squeezed of buying other things, margins get squeezed. Um, and so in addition to higher rates having a higher discount rate, which pushes down, kind of appropriate equity valuations, also their margins can be pressured unless they have a unusually large amount of pricing power. Um, and so that's why I think that you want to have some of those more inflation hedge type of things, or debasement hedges, however you want to think of
Right.
them. They're not always quite the same thing, to kind of counteract any, you know, disinflationary preference asset you
Yeah.
have, like the majority of stocks, the majority of bonds, and so forth.
And another thing, Lynn, just trying to think out loud and arguing with my own point, I do think that you can see the price of the stuff you need go up and the price of the stuff you want go down.
Yeah.
So, on net balance, you could have the CPI going down, let's just say disinflation, but yet the cost of gas is going through the roof. The oil price is going much higher. So the cost of commodities, the cost of food, the cost of energy going up, while the rest of the stuff like retail is going down, let's say, because of that dynamic we talked about earlier of people robbing Peter to pay Paul. And on net balance, you might see a decrease or flat. But within the CPI basket itself, there's massive volatility, and prices are going way up with the stuff that you want to own, such as commodities.
Yeah.
Chris, what do you think, buddy?
Yeah. It comes at a backdrop as well of a cyclical commodity cycle, right? So we have this lack of capex spending across the commodity space, in particular in the energy space. So that's a unique backdrop to this, should we call it, monetary fiscal environment that you laid out. I think what this time is a time of wealth transfer, not a time of wealth accumulation, or even necessarily sort of, there'll be some wealth destruction. Absolutely. I think certainly with respect to the, consumer spending goods and things of that nature. Your Netflix subscription isn't really that important when you can't make your mortgage payments, right? So when and like a lot of people will say to me, "Oh, well, I'm really concerned about the stock market. What are you doing, Chris?" I'm going, "Oh, well, I'm investing in the stock market," and I kind of use that as a joke. But the point is that we're investing in specific sectors and specific asset classes that are within the stock market, but they're not. People have this broad view of the stock market as being a thing, and it's not. So within that, I think you've got. There's a couple of things with respect to like debt, and I'll just come back to what you were talking about, Lynn, with the debt markets. One of the things that, as always, for years when I looked at the euro, I'm like, that's just it's a clusterfuck of a structural, market. And and one of the things that they failed to do, and they basically said, look, we'll fix this problem later, was to consolidate the debts, right? So they've never managed to do that. And I think now in this environment, in this global environment that we are in, that inability to consolidate the debt in Euroland is going to cause, or could cause, essentially capital flows into the US treasury markets by sheer default. As a like, where do you go, right? In a risk off environment that you alluded to, Lynn, what do you do in a risk off environment, right? So short-term T-bills, like short-term debt is kind of where you would park your capital. Certainly you've got massive liquidity there. Everybody could look at it and say, well, I'm worried about inflation, but you're only worried about inflation on a multi-year time frame typically, right? So that shorter term time frame, it's a non-issue, right? Inflation is not really the concern. You're just concerned with protecting your capital. So when I look at global bond markets, like, there's not, as screwed up as the US is with respect to its debt levels and everything else, the fact is, certainly within the Western world, there's not really anywhere else to go. Euroland is a massive problem, and the fact that they've are deindustrializing is really the support base to that entire bond market, which is not consolidated and is falling apart. And the euro itself, I think, is, if you I look at the first thing I look at in the morning is currencies. I just pull up currencies because it's kind of like almost like the bellwether for almost everything else on a macro basis. And euro has been sitting at resistance for a long time now. So I don't know what's going to happen there, but it feeds into what could happen in the bond markets, and that is where I as bearish as I am on bonds, and I believe we're in this sovereign debt crisis, I think that the way that can play out is really where, like a collapsing star, the energy comes back into the dollar first and into the US bond markets first. And remember, most of the cross-border transactions are still dollar-based transactions. 90% of all cross-border transactions are dollar-based. So this hurts a lot of emerging markets. It hurts everybody, where you have rising rates and an inability to service the debts on that. You were talking about the falling incomes within. That's a domestic issue within the US, but imagine that at a global scale. Imagine that at a scale whereby it's not just
if your income was
companies,
denominated in yen.
Exactly. And so this is when you kind of scale back and you look at the whole macro picture, it's a very precarious situation. And that's without even looking at the geopolitical conflicts and the political conflicts that are taking place. And so I think,
and oil being priced in dollars. I mean,
oil being priced in dollars,
double whammy right there. You get oil ripping to 150, let's say, while the DXY is at 110, and holy cow, that is that's
and people forget that that's a massive issue for emerging markets.
Well, it's emerging
Like, I mean,
markets. It's a massive issue for
it's a big issue
developed
for
markets.
us, for everybody, but it's a significant issue. And I think, look, we don't know what's going to happen, but one of the things that history teaches us, and you also see this in nature, when things get too extreme, they don't repair, they just break, and you have a completely new system that gets built. But that breaking process can be very, very difficult. And so, the break from the dollar, if you will, like that entire global monetary system as it's tied into the dollar, realize also that's a weapon. And so at another level, you've got the ability to weaponize the dollar.
Yeah.
At a political level, right? So I think people need to just be a little bit cautious with respect to being very dollar bearish and very US bond bearish. And that comes from a guy who's like, it's a sovereign debt crisis. That's what we're in. But it's not that simple. The way that plays out
I think
is
that's what Lynn's
nuanced.
kind of talking about with the short term. But then
Exactly.
long term, you got to look at the structural dynamics right there that are at play. And to her point, her base case is within the year, there will be more currency units chasing goods and services that will allow the US consumer to purchase both the stuff and the commodities that they need, and therefore allow that I hate to call it a wage price spiral because I think that's kind of bogus, but allow that concept to to play out. Another thing I want to talk to you guys about that I think is a hot topic, and again wrestling with it, is gold. Because on one hand, if you are to assume that the tensions or the conflict in the Middle East escalates, and obviously we hope that it ends tomorrow, but assuming that it doesn't, especially if the US gets involved, if Iran gets involved, you would expect gold to go to all time highs. But at the same time, if you look at how gold usually responds prior to a recession, it usually goes down. And then when the stuff hits the fan, it really goes down because that's the only thing that people have that's liquid right on the balance sheet. So they're going to sell that. Gold is doing its job. And then what happens is when the central planners come in and the authoritarians with their economic distortions, and whether that's massive deficit spending or QE or whatever it is, that's usually what makes the gold price go higher. So you have these two dynamics at play. And I'm trying to figure out, what my base case is. Is it that the geopolitical risk is going to take over and that gold continues to go up, or will those, if we do have a recession, assuming that hits in 2024, is that going to overwhelm the geopolitical tension and gold does what it normally does, sell off, and then as a response from the central planners, rips higher? How are you guys thinking about that?
So I think that's part of why you want to consider things like T-bills to accompany gold you might have, so that you can kind of either rebalance or protect yourself from the volatility of those types of events. Another complicating factor is so you mentioned cross currents. In the prior discussion around capital wanting to flow into the US for safety, one of the unintuitive challenges that makes that market hard to analyze is that quite intuitively, dollar strength and foreign bond demand are somewhat inversely correlated.
Yeah, this is a great
Not
point.
not out of desire, but out of like mechanical necessity. So basically,
Right.
when there's a dollar shortage, dollar is very strong. And we have to keep in mind, as energy prices are pretty high right now. But when you have a combination of a strong dollar and high energy prices, they're very high for the rest of the world. So they're very high for Japan and Europe, and they're super high for much of the developing world right now.
Mhm.
Um, but in general, when you have a strong dollar, especially when you have a strong dollar that's rising, right? So it's both rate of change and high magnitude. The foreign sector is in defense mode. Instead of going out to accumulate reserves, they're defending their currencies. And so the rest of the world has a positive net international investment position in aggregate, meaning
Right.
that they own a lot of US assets. And those are things that they can turn to should they need dollars.
Such
They
as
begin
treasuries. Right.
Yeah, they can sell treasuries, they can sell equities if it gets bad enough. And so in a kind of a slower grind risk on scenario, I mean a risk off scenario, the dollar might rise a little bit, people might pour into treasuries somewhat. That's kind of like the what you saw in say 2019, for example. Kind of a slower risk off of scenario. But when you have that sharper risk off scenario, that's when you get that, dollar up and yet bonds down,
Mhm.
because the foreign sectors,
Bond yield.
even if
Right. Oh,
they'd
yeah.
like to own them, they just don't. They're selling what they have to get dollars to either buy oil, defend their currencies, whatever they might be doing. And also, that's generally an environment that's tricky for gold because gold is historically, the stronger the dollar is, the more positive real rates are, the bigger of a headwind that is for gold, all else being equal. Now, I would say that gold has held up pretty well considering what just happened with rates and real rates, in the past couple years.
Mhm.
Um, and I think that basically it comes down to a question of how long your analysis indicates they're able to maintain positive real rates given the large fiscal budget deficits they're running, based on the prior questions of who's going to absorb all this treasury issuance. Because if it's a strong dollar, it's unlikely that the foreign sector is going to be able to absorb a lot of it, and we're already seeing that. Um, and so I think basically the next 8+ months, maybe 12 months, they're able to still kind of maintain monetary tightness and fiscal looseness. And if you go back to say like market wizards like Stanley Druckenmiller,
Yeah.
that has historically been a recipe for a strong currency. That aggressive fiscal stimulus mixed with tight monetary policy is usually currency positive as long as they can maintain it. But
Mhm.
it's not like an indefinitely maintainable situation. Eventually, you need that monetization to help with those deficits. And I think that's when you risk having, maybe a local top in the dollar, maybe a reacceleration of money supply. Um, but depending on what your time frame is between now and then, which could be 6 months, could be 8 months, could be 12 months, this is something you have to, kind of monitor on a regular basis. Most things still point towards T-bills, tips, gold, but I wouldn't be all in gold. I would balance that with the other types of assets, because we're still in this at least currently positive real rate environment, and a currently environment where they're trying to tighten the unit of account, which is the dollar. And so whenever you're denominating assets in a unit of account that they're doing their best to tighten, that just poses a headwind against most types of assets.
Yeah, talking about the dollar, it reminds me of I was just in St. Bart's with Hugh and Snyder and Brent and a couple other hedge fund managers, and I was just absorbing it all. I was really a fantastic time. But one common denominator that all these guys had is they make decisions starting from a global macro fundamental view. That's where they start. But then to actually pull the trigger, then they start overlaying technical analysis. So as an example, one of the things that we were talking about there was the dollar. So these guys would start with, okay, for because of China, because of Israel, because blah 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 blah, global macro. Therefore, longer term, I'm bullish on the dollar. And I'm just using this as an example, right? Or bearish, bullish, whatever. And then what they would do is they would look at the chart of the DXY and they would see, and you guys probably know this terminology better than I do, but they would point out like resistance levels. And I think one of the resistance levels that they pointed out on the dollar going up was like 105.6. We hit that before. And then they kind of zoom out and they say, okay, where are other resistance levels? And they say the next one's at 112. And then the next one's, let's just say, at 120. And so then I'd ask them, okay, so you don't pull the trigger until the charts tell you now is the right time to do it, and you use these resistance levels and how much if it breaks through that resistance ceiling, on volume, how long does it stay there? Does it retest and then go back up? Which is what we've seen in the dollar. This is kind of what I'm getting to. So how much technical analysis do you guys make when you're actually making a decision as to whether to pull the trigger to buy or sell based on your longer term global macro view?
So I basically I'll take net positioning or with little regard to that, and that's more around adjustments and weightings, right? Where you see particular things unfold in the markets, and that's across all sorts of markets. So for me, it's kind of like almost like you're building a foundation. You go, okay, what does this foundation need to look like? I need a bit of this, I need a bit of that, right? So you build that based on fundamentals, based on the macro, and then because you need a starting point of some description, and then these things that we're discussing now are more tweaks around um, around adjusting that, and that's more about weighting of positions, right? Because let's say you've got, I don't know, 5% position sizing in something, it's not sufficiently material within your portfolio for you to have a huge concern around resistance levels or anything of that nature, right? At least not from my standpoint. I don't look at it like that.
Okay.
So that's basically just, I mean, and I'm not saying that's the answer. That's just the way that I've found it to be most useful, because there's so much going on. It's actually difficult for you to if you it's a decision making process, right? So how do you get to a decision? And you can't like forever not make a decision. Right? Not making a decision is a decision in itself, and so you've got to have something to start with. So that's basically how I look at doing it. I'll just make one other point with respect to gold, which you were talking about before. And there's the saying that the general always fights the last war. And so the last war that we had essentially was a liquidity driven event, right? If you look at the GFC,
Mm.
in a liquidity driven event, gold doesn't do anything for you because it's not a liquid asset. not that liquid an asset. Like the size of the gold market's tiny, right? It's not at all like a treasury market. And so I think there's a certain element that we're working with here where the vast people on the planet that are managing money are still in a situation where they're looking back and they're saying, well, that's an issue that we need to be concerned about on a go forward basis, which is a liquidity driven event. How
Oh,
do
and
we
therefore
hedge
gold
against
going
that?
down into a recession. Is that what you're saying, Chris?
Exactly.
Okay, got
So I think that could have some impact. And really, gold, when I look at it over periods of history, gold tends to move as a on a on a loss of faith more than it does on deflation or inflation. It doesn't actually move on inflation. Sometimes it does, but then there's other periods of inflation where it doesn't. And you
right.
go, well, why is that? So, and it's like if I was going to bring it down to one element of why, it tends to be a loss of faith. I think that we're moving more rapidly towards that as some end goal. So I think it has to be in a portfolio, but keep in mind that we could have multiple environments along the way whereby they're deemed or at least viewed to be liquidity type scenarios. And in that environment, gold doesn't necessarily do anything.
Right. Okay, Lynn, what do you think about the technical and the charts? Do you use them for anything? If so, what?
About 5 to 10%. Basically, the way I view it just primarily as a little bit of risk management in the sense that I have a fundamental view, and part of that will come down to timing, meaning that I like this, but only after this. In other words, like we just already discussed, there's a number of assets I like. Once we get past this point where the Fed is still able to reduce their balance sheet, then I think that some of those get more interesting. And one thing that separates kind of a trader from an investor is a trader might switch out their entire portfolio on a regular basis. They're saying I'm long this for this number of weeks, then I'm out, then I'm in this, then I'm out again. An investor in many cases more like if you're driving a fast car and you're going around a turn, you slow a little bit, and then when the time's right, you accelerate out of that turn, right? So
Right.
there are either technical triggers or big changes that just happen fundamentally, like the repo spike of September 2019 or the liquidity bazooka of March 2020. There are kind of these major either fundamental or technical turning points where I might concentrate more in a thesis that I like for various fundamental reasons. And so when I use technical analysis, it's mainly to just say, I don't want to buy a falling knife. If there's an asset I like that's going straight down, I want to wait until it settles to some extent. Start showing some degree of like a high volume bottom before I might lean into that asset. So I do pay attention to some basic ratios and technicals and things like that, but for the most part, I do fundamental analysis. And going back to the question of credibility, that's why I think this and I keep coming back to it, this reverse repo facility and other matters are so important because right now, most indicators suggest that the market has a high faith in the Fed's credibility. If you look at forward, 10-year break evens, they're at, 2.5%. So inflation expectations forward are pretty low. Long-term oil expectations are not very high. Um, right now there's positive real yields. The market seems to expect that can continue despite the, very high debt levels, very high deficit levels. And so basically whenever they see high inflation, they say, okay, that means the Fed's gonna have to be even tighter. They've got this under control. And again, as long as there's a pool of liquidity that they can draw from or let the market draw from, like reverse repos, they're able to maintain that. I think where credibility gets a lot weaker is when the Fed kind of runs out of some of their liquidity tools. Inflation is either still above target or maybe it goes below target, but then starts coming back above target again and they're unable to keep reducing their balance sheet and they might even be in a position where they're moderately increasing their balance sheet again, and I think that's where you get a credibility sea change when they realize that most central bank tools are designed to um, kind of control money creation through the bank channel, right? So they're designed to either accelerate or slow down bank lending, which is one of the key ways that money's made. Whereas their tools are not very good at dealing with a structurally large fiscal deficit and a very high public debt to GDP ratio. And I think once the market increasingly realizes that that's the position that the Fed is in, I think we enter somewhat of a different market regime than we've been used to for the past several years.
Yeah. So how that plays out is inflation remains high, but yet the Fed is forced to start doing QE.
Yeah, in a similar way that you see Japan right now, except that would be an environment of also having a trade deficit. And, most of when people think of Japan, they think of like this past decade, that Japan didn't really ramp up their balance sheet until late 2012.
Mm,
And so the past 11 years, their balance sheet's been going almost straight up. And most of that was a commodity bear market, right? So they're able to inflate asset prices without really, worrying about other things. They've also been deleveraging their corporate sector. But when we look at going forward, if you have a commodity bull market, so there's more tightness in the commodity space, and um, you're doing it from the perspective of being like a structural trade deficit nation as well. So twin deficits, uh, things start to get more interesting, more stagflationary, you could say, and that's where I think that some of the stock bond correlations get messy. That's when you might get a stronger bid for gold, maybe another bull market in Bitcoin. Those types of like pro liquidity assets, I think would generally benefit from that, as well as just loss of perception around the Fed's ability to maintain the structurally positive real yield. So you can get to periods of positive real yields, but the question is when you have 130% debt to GDP and this large fiscal deficits, can you maintain positive real yields? And so the bet on those types of assets would be basically be saying no, I don't think they can. And whereas if you do think they can, that's where things like T-bills, maybe long duration bonds, tips. I mean, those start to become more interesting for people who do have their view that they can hold positive real
yeah.
yields.
Or if you think the money supply is going to continue to decline or
Yeah.
continue you flat, because that at the end of the higher prices actually lead to disinflation and deflation.
Yes.
It reminds me, Lynn, of that tweet that you put out. This was probably, it probably was 2 years ago, because I think it was before we saw that big spike in the CPI. And this is when you first started talking about the 2020s looking a lot like the 1940s, which is something that I've echoed many, many times. Much I totally agree with you on that. But you said in this tweet that throughout the next decade, it's most likely that the inflationists and the deflationists would both be dunking on each other, just at different times. Because if you look at the 1940s or the 1970s for that matter, inflation it never goes up in a straight line. The deflation doesn't either. It's always this roller coaster ride. And I think that's the main point here is people and amateurs try to look at their portfolio or assets and determine, okay, what can I buy right now that's going to go up in a straight line? And I think one of the main takeaways here, guys, is when you're building your portfolio with portfolio construction, you've got to understand that never happens. Ever, ever, ever. Assets never go down in a straight line and they never go up in a straight line. So that's something that we need to be cognizant of. And we need to set up our portfolio. And probably more importantly, we need to set this up and our emotional capacity to be able to handle that.
I
That's a
agree.
great point. You think of the 70s. In that first wave of inflation in the 70s, it didn't like bonds didn't get they worked okay. I mean, it wasn't great, but it was the second wave they got torched.
Yeah.
And and it's you know, it's one of those mind games, right? So because people kind of saw the first wave and they probably got a little bit complacent. They're like, oh well, that's what it is. I know what that looks like now, right? Because obviously prior to that there was not that much of an experience with respect to inflation, so it was like, oh okay, this is what it is. Oh, that hurt. Oh, ow, ow. And then they felt like they knew what that was, and like, no, you haven't. That was just the
Then they get the
advertisement.
rug pull. The market's always going to wait till the maximum pain can be inflicted and then give it the rug pull. It happens
It
over
is.
and over and over again.
The other environment, I think the environment that we're in today is also it's a much more macro environment than, say the 70s, for example. In the 70s, the US was still extraordinarily dominant. And while it is still dominant today, it's a different environment.
Mm.
And this, I don't know, I don't have the answer to this. And Lynn's far smarter than I am, so maybe she's got some answers to it. But if you think about Japan, like the experience, and everyone talks about, the multi-decade of Japan's deflationary experience, etc., etc. When I look at that, I'm like, yeah, but that also took place in a macro environment that was very benign geopolitically. It was a time of continuously falling rates. So if you took away or you changed some of those dynamics, I'm not sure that Japan would have had the same experience. In other words, if you had a macro environment where rates were rising,
Mm.
would they have had the ability to do what? I don't think they would. Now, again, it's hard to go back and think about what, because one factor doesn't necessarily change everything, and there's, but it sets people up for a situation where we need to be very attentive, right? Because the idea of just looking, for example, at Japan and saying, oh well, they've always had this, and look, they've done that, and I see a lot of people saying, oh, we're going to be the next Japan, and this is why, and it's like, it's not that simple, right? So it's, um,
Yeah, the next step I think here is to give people some actionable tips or advice, if you will. It's not personal investment advice, but I'd like to discuss maybe just a couple of your strongest ideas, or maybe the ticker for some, 2 or 3 of the stocks or assets that you're most interested in right now. We'll start with Chris. For your, the way you're managing your clients' money, or for your own portfolio. What are your top couple investment ideas, just let's say for the next 6 months, and then maybe a couple tickers that you like?
Sure. I'll just precede that by saying that I think the idea of picking out 1 or 2 stocks as a go forward for any particular time frame is a poor way to manage any portfolio. You need to have an actual portfolio approach. So that being said, we've been extraordinarily bullish on offshore oil assets in particular, largely as a consequence of no capex spending, that as well as the offshore oil tankers, but especially in the offshore drilling space. That's just a very unique environment. It's one whereby we're not getting away from that, despite the idea we're going to be running the world on renewables. And it is just a very, very long cycle, capital intensive sector.
Okay.
So, I don't know what happens in the short term, but I'm very, very comfortable to be very long that sector for the next number of years, because there's just an inability to bring much more supply on board with respect to rigs and OSVs and all that kind of stuff. So that's that space. I could throw out a few tickers. You could look at Tidewater, Valaris, whatever. So the other thing that is coming up, which is only what are we now? We're like a week away, which is the Argentinian elections. This is something that we got into in late 2021, was going along particular assets in Argentina. And I think I say that because I think over the course of the next weeks and months, you're likely to see a lot of MSM talking about what a terrible situation Argentina's in, because there's a new guy in there and he's a complete right-wing extremist nut, and he's, because Milei, who looks
They're
like
going to give him the Elon treatment or the Trump treatment.
He's going to walk in there with a
he's
kitchen
gonna be the
sink,
next target.
just fire everyone. Now that probably means that we'll have a period of chaos of, I don't know, 6 to 12 weeks, right? You imagine just eliminating entire swathes of government bureaucrats. But I think it's likely the Elon type scenario of Twitter, I think, is not a terrible analogy. In any event, if you look at the asset classes there, I mean, I don't necessarily like banks, but you could look at like what's Banco? I'm trying to think of the ticker now. It'll come to mind. They're like trading at about a third of Bank of America in terms of valuations. They're way more. They're like, in terms of return on assets, like they're about 3 times more profitable. So the market's not pricing this. Now, I don't know what's going to happen, but all investing is a matter of probability and looking at reducing your risk where possible and having a bunch of upside situations. And I certainly think Argentina is one of those. And like, again, we've done very well out of it. So you've got to be careful that you don't have some sort of bias where you're thinking, oh well, it's loved me so far, and it's going to continue to love me, because you're not getting married. Yeah, this is just investments. But I do think that that's a very, very interesting part of the world to be looking at. You could look at YPF, which is the equivalent of their sort of Exxon, if you will. which is an energy asset there. It's still cheap. They're going to be developing shale as well, and so those are the two that have been, I guess, front of my mind for the last 6 months.
Okay.
Are those two sectors? Yeah.
All right. Great. Lynn, what do you think?
So I think in the next, call it 6+ months, T-bills, tips, these are some of the more, they're boring, but I think a number of assets are going to have trouble kind of dealing with them on a risk-adjusted basis. So when you can get 5+% nominal yields with limited duration risk, when you can lock in positive real yields with tips on an intermediate term basis, these, from a defensive standpoint, those are attractive assets.
Yeah.
Um, I also, like I said before, even though, for example, I have been, say, cautious around copper in the cyclical sense, I've been pretty bullish on energy producers. I don't really have any opinion on what they're going to do in any time period, but I'm not waiting to be long those um, because they're low valuations. Many of them have strong balance sheets, um, and they're paying good dividends. Some of them are buying back cheap shares. I mean, these are basically positive carry positions on the future of energy security, energy instability. So if oil just stays where they are, um, these are cash flow positive businesses. And if oil does have a big spike up, whether it's next week, whether it's 3 years from now, these would benefit from that. And I generally view risk to the downside in oil to be somewhat limited, just because of how tight the supply side is. Um, and they're in a position where they can withstand lower oil prices for a period of time if they need to. And so I do like that risk reward overall. Um, and then, I have a number of more traditional equities. I mean, kind of growth at a reasonable price stocks. Visa, for example, Adobe. That one's getting ahead of itself now, but I was kind of bullish on that earlier this year. There's a number of things like that that I kind of let run for long periods of time while I heard hold some of these other either more inflationary or more defensive assets. And then, you know, most of these assets we're talking about in the context of a portfolio, but then there's also bearer assets, assets that you can hold directly. And those are things like gold or Bitcoin. And again, in this kind of strong dollar environment for the next 6+ months, I don't really have a strong view on what they're going to do. But I would expect both of them to do pretty well um, in the next upward rise in broad money supply when the Fed is no longer able to keep the tightening that they're currently doing. And so I view this as kind of a long-term accumulation zone. With bear assets, it's like buy before you need it and just manage your expectations around price until you need it. And so that's generally how I'm playing it. Is that, like Chris said, not just a ticker. There's no magic ticker. It's more just like a portfolio strategy that is meant to be relatively balanced. It's still geared towards certain macro expectations. Generally a more inflationary bias than the typical 60/40 portfolio, but one that tries to balance different scenarios that can kind of absorb volatility and push forward, more cautiously over time.
Yeah, that makes a lot of sense. Can you talk about the model portfolios that you have in Rebel Capitalist Pro? So most of the people on this live stream or watching this video know that you two are my partners in Rebel Capitalist Pro. I'm always the amateur. I say it's Chris and Lynn that are the pros in Rebel Capitalist Pro. That's for sure. But in Rebel Capitalist Pro, you've got some model portfolios along with a lot of your research that you do. So can you kind of walk us through those portfolios that you have that people might find value from?
So I'll start, I guess. So basically, I have a number of these kind of like investment pies. So I kind of base them around M1 Finance, which is very convenient for making these kind of pie chart type of portfolios. And so I have one that's ETF only, so it's meant to be relatively simple. I have other ones that are more individual stocks combined with ETFs. And again, there's different major segments. So you'll have profitable companies that are growing. You'll have more of a commodity type of approach, and then you'll have defensive assets, things like T-bills or tips. And I segment those into categories. I also have a portfolio that I host in Interactive Brokers. That's in a more traditional portfolio environment, so less of a pie chart view and more of like a smaller number of equities, smaller number of ETFs, kind of a moderate number of holdings. And I reveal, every kind of 2 weeks what I'm looking to buy, what I'm looking to sell. I have a fairly low turnover approach, but I'm always evaluating the portfolios to see, okay, what has gotten ahead of itself, and then I might want to trim out of, or what, maybe I was bullish on something and the thesis has not been working, and it's, my views change, so it's like, okay, I'm gonna cut that, cut the loss before it gets worse, and go back into something that is more interesting. So I'm always kind of slowly managing the portfolios around the changing world that we have.
Yeah, yeah, and one of the things that's great about Rebel Capitalist Pro is you and Chris do live streams. I think, is it twice a month?
Yes.
Okay, yeah,
Once every
twice
2
a
weeks.
month.
Yeah.
And I do one once a week. So if the members see one of your model portfolios and if they have a question about that, or if they have a question about anything, they can go ahead and ask you in those exclusive live streams that we have for the Rebel Capitalist Pros. So that's fantastic as well. Chris, I think you put in your research letter in Rebel Capitalist Pro that you write for your hedge fund clients. Is that correct?
Yeah, that's how it started. Was writing letters to hedge fund clients, and then that's what sort of turned into the publication side of things, which is much more broad now than it was before. Simply because there's a much more diverse range of readership, everything from your university students figuring stuff out through to multi-billion-dollar asset managers looking for some ideas. So it's a broader sort of newsletter side of things. But that's, I mean, that's a Rebel Capitalist Pro product, if you will.
Yeah. To be clear, the back end research from Chris and
Yeah.
Lynn, and then those live streams, those model portfolios. So with the live stream, Chris, what's the typical type of question you get? Give us the range.
Yeah. Wow. There's huge ranges. I mean, I guess over the course of the last few years, there's been more questions with respect to, um, shall we say, our Malthusianist friends,
Yeah.
um, and and how one might mitigate the risks with that. Which part of that is a financial issue, right? You can't do a
Right.
whole lot of anything if you haven't got any capital. So we need to protect our capital and grow it as best as we can. But the ultimate goal is like, well, what do you do with that? Like, and so what does that afford you? Well, we want it to afford us a life of certainly freedom. So I do get quite a few questions with respect to that, and so that's often jurisdictional. Where, why, how, who's doing what, where, and we spend a lot of time on that. To be
Yeah.
fair, because I do feel that is a precursor to and will continue to significantly influence capital flows.
Yeah. I
Right.
mean, one thing that we all learned in 2020 and 2021 is money can only get you so far. The number one priority needs to be your freedom. Because if you
Absolutely.
haven't got your freedom, if you're locked up in a cage, it doesn't matter how much money, Bitcoin, gold, real estate, XYZ you have, uh, you're still suffering. So freedom has to be our number one priority. So that's definitely something that we discuss. Those are questions that I get all the time too. A
Yeah.
lot of Plan B stuff, along with the gold, the Bitcoin, the investing, the real estate, etc.
I
So
do notice that you get. Sorry, I'll just give you one extra little thing. I
sure,
do notice that you get a lot of questions, like where there are new subscribers, around more specifics of like, this company. Should I buy this company? Shouldn't I buy this company? That sort of things.
mm,
The longer term subscribers in there, simply because they know me better, will not ask that question as much. And the reason behind that is quite simple. I think people need to have a portfolio approach,
right,
especially in the environment that we are in today. Consider if you were an Israeli and you had all your equities in Israel. Now, basically, the Israeli stock market's doing just fine right now. But the point I'm making is that we are at a time where we have significant geopolitical risk,
mm,
and the idea that you would solely invest in one location, to me, impresses me as completely absurd. And I
right,
think that's important for Americans in particular, who have not for decades had to even consider stepping outside of the US. The amount of investors that come to us who just don't even know how to get a brokerage account that could give them access to anything outside of US markets is quite astounding. And I think it's a risk that people have not fully grasped. So that's all I'll say on that.
Yeah, that's one of the greatest benefits of Rebel Capitalist Pro and everything that we talk in there. We all have a similar worldview and similar priorities from a standpoint of freedom, liberty, free market capitalism. We all realize that the world is a very uncertain place right now. So you've got to not only have a diversified portfolio, take that portfolio management approach, but also have that geopolitical diversification, not only with your portfolio, but hopefully your own personal situation as well, whether that's a second passport, whether that's different bank accounts and whatnot. So that said, guys, if you want to check out Rebel Capitalist Pro, if you want to become a member or even just check it out, you can go to georgegammon.com/pro. You can have a trial for a week. You can hop on there, look in the forum, talk to other members. You can look at some of the back-end research from Chris, their letters from the past, going all the way back to, I think, 2020, guys. Don't we have that archived all the way back over the last 3 years? And I don't know if this is the right URL, Josh. I think it might be just georgegammon.com/pro. So that's georgegammon.com/pro. You guys can go there, sign up for a trial. You can hop on a live stream with Chris Lynn, Brent Johnson, Patrick Serezna, Jason Hartman, and then me once a week. So you guys can check that out. Guys, thanks a lot for an incredible conversation. I think there's a tremendous value. We got some actionable advice, and we're able to get inside your brain and really try to understand what you're thinking about and what's most important right now. And I think the main takeaway, if you would agree, is that people need to be cognizant of what's happening in the world, because most likely going into the next year, it's going to become very volatile.
I would concur. It's been good fun. And I always get a lot listening to Lynn as well. So it's good to see you again.
Same for you, Chris. Happy to have these discussions.
Yeah. All right, guys. Enjoy the rest of your day. Have a great weekend, and we'll see you inside Rebel Capitalist Pro.